Hey, what's up, everybody? Today we're going to be taking a look at Phil Town's portfolio at the end of Q3 2024. Now, we found out that he sold out of PayPal stock completely in the quarter, and he bought a brand new stock, which we're going to focus on in this particular video here today. Now, this is for the Watch My name is Justin. I am a big Phil Town fan. I took his vesting class about 4 years ago, and I follow a lot of his strategies here today. In fact, a few of the books behind me are his books. So I'm a value investor. I appreciate his strategy, still utilize it here today. So I thought I'd share with you guys, my thoughts and feelings about his current portfolio and his brand new stock. So let's go do that now. Okay, on the screen right now, you can see his current portfolio at the end of quarter three, 2024. His largest, by far his largest position is actually his cash position, which has grown a lot in the quarter. So it's roughly 44% of his total portfolio right now. So almost 50% of his portfolio is in cash. That's an increase of 55% position overall. So basically that has grown almost $29 million in the quarter. His total portfolio now is worth around $188 million. Now, as far as strictly equities in his portfolio, his largest one is Netflix, which is roughly 22% of his portfolio. He's done tremendously well in this particular stock. I mean, it's trading around $700 here today. I mean, he was buying it all the way down into the 200s, low 200s, even below 200. So he has done extremely well in this particular position overall. He did reduce it 10% in the quarter. I'm sure that's just because it's grown and some of the calls got called away from him in the quarter. Next one up is Occidental Petroleum. That is roughly about the same. He didn't sell or buy any more in the quarter. It's about 7% of his portfolio. Big oil producer. Warren Buffett has certainly owned a lot of this stock, one of the bigger stocks in his portfolio. Some other value investors have done that as well. Sprouts Farmers Market reduced 18% in the quarter overall. It's worth about 7% in his portfolio. Next one up is Howard Hughes. No change there. It's about 6% of his portfolio. Alphabet, also known as Google stock, no change there. It's about 5% of his portfolio. Sturm and Ruger, same, it's 4% roughly his portfolio, no change. And so his new stock, and we'll talk more about this one here in a second, but this one's Capri Holdings. This is a company that is in kind of the fashion industry. They own a couple of different pretty big names, including Michael Kors. And this is an interesting company, interesting stock right now. Very, very interesting, which we'll get into. Ulta Beauty, no change there, less than 1% of his portfolio. I think he wants to buy more of these. I looked at his option contracts, and he has sold puts on this particular stock around, I think I saw some at $360. And there's another strike price in there too, but I remember seeing about 360 on that. So I do think he wants to increase that position. And then Banco ZK, I mentioned this in a previous video that he's not happy with the CEO, the owner of the company. This last earnings call, there was some stuff that went on from one of the analyst questions in there. He was not happy with the answer, and he has dumped 91% of the stock. So it's less than 1% of his portfolio. And this is a pretty big deal because he's had this particular stock for a while in his portfolio. So let's actually, before I talk about Capri Holdings, let's go down here a second. So PayPal Holdings totally sold out of that in the quarter, all 30,000 shares. Now, I would not be surprised he gets back into this one because I did see him sell some puts in the quarter, so he may get back in this one. And then he has sold out of the Gold Miners ETF, ticker symbol GDX. So it's that. So let's talk about Capri Holdings right now. This is, again, a very interesting stock. This is a stock that is down. Man, it is down big time. I mean, year to date, it's down 60%. So it was about $50 at the beginning of the year. It's trading at $21 here today. 60% drop, massive drop. And even in the last couple weeks, it's dropped even further. And there's a couple ways you can look at this. Let's kind of first focus on this massive drop here recently. So Tapestry wanted to merge with Capri Holdings. Capri Holdings right now is worth around $2.5 billion. Let's see Tapestry. I'm not sure right now what their market cap is. I know it's bigger than $2.5 billion. It is currently it's about $13 billion. So Tapestry is quite a bit bigger than Capri Holdings right now. I mean, you're talking 5 to 6 times the size. But they were going to merge, and there were some issues with that. And I know there were some appeals going on. We just found out in the last 2 days that the merger is not going through. So it was decided that that merger was going to be canceled, and you can see that's why the stock just fell off the face of the earth pretty recently. And keep in mind too that the company had really been reluctant to kind of hold any kind of investor presentations or anything like that until the merger was done, which I think has also hurt their stock price as well, just because we're not hearing the communication consistently like we were before. So I really do think that has hurt the stock price, because investors, when you're not hearing from the company and the company's not doing really well, that's a problem, and we'll see that here in the numbers. But it's a company, like I said, that holds some pretty impressive brands overall. Again, Michael Kors, Jimmy Choo. I mean, there's some pretty big brands that people would recognize. It was founded in 1981, and it's in the United Kingdom. So now let's go take a look at some kind of financial numbers for them. If you're a follower of Phil Town like I am, he'll talk about the Rule 1 numbers: sales per share, earnings per share, free cash flow per share, book value per share, and then return on invested capital. I also threw in return on equity as well, so we can see that. Pretty interesting, because growth-wise, over the last 10 years, the company's only grown 8% for sales per share. Some of these numbers are even bombing out because they had negative earnings per share over the last year and a half. What really interests me is that this book value per share is only up 2% per year. If you follow Phil Town, you'll know that book value is very, very important to him. In fact, a lot of times he will value companies based on the growth of the book value per share. And the reason for that is equity in the company. And if you think about it, as investors, we own a piece of the equity of the business. So we want to see that grow, hopefully double digits year over year. And it's only grown 2% per year. But if we dig into that, we look at the balance sheet specifically, you can see down here, this row. Let's see if I can try to highlight that a little bit. And you can see it's gone from 2.2 billion to 1.4 or 1.4 billion. So on the surface, that looks like a huge problem, right? And and that's factoring into the book value per share. You take the equity divided by the total shares, and that's kind of where the book value per share comes from. But what's going on is this treasury stock line here it's going down, and it's going down year over year. So there was negative 500 million several years ago. Now it's negative 5.4 billion. And what that is the company's been buying back a ton of shares in the market. So this treasury stock just represents the stock essentially that they're buying back from the market, and they're retiring. So that's actually a good thing. And that's why a lot of times it's good to dig into the financials to really understand what is going on, because on the surface you see only 2% growth for book value per share, but what's happening is the company's actually buying back a lot of shares and consistently buying back a lot of shares, which is a good thing, because that means your piece of the pie of the company is actually growing. So it's actually not a bad thing in this case that book value per share is actually not growing as fast as we'd like. It's because they're buying back so many shares in the market overall. So I just wanted to point that out. That's not necessarily a bad thing from book value per share standpoint goes. So interesting there. Now, if we look at some other numbers as well too, like to take a look at, which is debt and some other things here. So from a debt perspective, they can pay off their long-term debt in about 3 years. This is a company on the surface that looks like they have a lot of debt. However, when you dig into it, they have about $1.5 billion in capital leases. In 2019, there were some new regulations that came out called ASC 842 that is requiring companies to basically take the capital leases that they are in contract with for their buildings or land or whatever the case may be, and they have to put that on the balance sheet as a liability and actually as an asset too, which my background is in accounting and finance, if you're wondering. But the asset side is a right of use asset. So kind of strange. I've always said that I think as accountants looking after each other on making sure that we're employed in the market with these kind of weird stuff that they do sometimes. And it's not all bad, but I can understand why they kind of did it, but it kind of skews the number when you look at stuff historically before 2019. Nonetheless, though, the company does have a current ratio under a 1, so their working capital is negative right now, and historically it hasn't been. So that's something to keep in mind, how their current assets grow versus their current liabilities overall. But gross margins being over 60% for a manufacturer, that is really solid. And their operating margins on average over the last 10 years have been 16%. It's only 4% in the trailing 12 months. Another reason why their stock has fallen off the map so much. And even right now, their PE is technically, it's zero, it's showing negative here, but it's technically zero because they don't have any earnings over the last trailing 12 months. So, some of the numbers are concerning, some of them are not concerning here overall, but I just kind of wanted to show you guys that. You can also see that their shares outstanding have diminished considerably from 176 million down to 117 million here to date. Now, if we look at, a valuation, for this company, let me show you guys here. And so this is my discounted operating earnings model. If you're interested on knowing how to calculate intrinsic value of companies, I do offer this template here along with a couple other templates as well too on my Patreon. I train you on exactly how to use these models so you can value companies yourself. So if you are interested in that, I'll put a link down below. You also get access to my Discord channel as well. And this particular valuation is really strictly going off what analysts think the company is going to do over the next several years. So this is not my personal valuation. This is what analysts think what's going to happen, and so this is where they think it's going to go. So last year they're at $5.1 billion in sales. This year it's dropped a lot. I think it's going to be around 4.5 billion. Now, keep in mind their fiscal year I think ends in March 2025. So kind of a weird fiscal year end. A lot of companies like to do December, but this particular company likes to do it in March. And then it's only supposed to grow to about 5.4 billion in 2028. So that's only a 1% growth per year. So pretty much flatline over a several year period. What's interesting to note, though, is that operating margins, even though a year ago they were around 10%, last trailing 12 months they've been 4%, they do think it's going to recover. Keep in mind, operating margins for the company historically have been between like 10 and 18%. Analysts do think it's going to recover and get back to the 13% mark. And if it does that, that would put their operating earnings growth at 6%. If you double that, you get a multiple of 12, which I'm using here. That comes in an intrinsic share price of $35. And so if we say, hey, we think this is going to happen this way, these assumptions are correct, that would put a margin of safety right now of the stock around like 35%, 40% actually, closer to 40. So it's looking, according to analysts, look like a pretty decent buy right now. I just think there's a big shock in the market, especially recently when the merger was called off. So if the company can recover, get back to their operating margins, even keeping sales flat over the next several years, the stock does look really undervalued right now. But it'll be interesting to see as this thing progresses, how the company does. Can they recover operating margins, because their SG&A has grown so much. If you go back I think it was about 5 years ago or 6 years ago, they were at the same revenue they did the last trailing 12 months. Their SG&A was $1 billion less. So their SG&A has grown tremendously. So this is a company that really needs to look at their costs, operating expenses, and really start reducing those. And from an earnings standpoint, too, it's very confusing because they have a ton of asset write-offs. They have goodwill write-offs going on. So there's a lot of noise going on their P&L right now. I think it's hard for investors to kind of work through and try to figure out where the company is and kind of where they're going. But interesting. On the surface, it kind of looks like a pretty interesting buy nonetheless. So that was Phil Town's portfolio at the end of Q3. We took a hard look, obviously, at Capri Holdings and kind of seeing where analysts think the company is going to go over the next several years, and it does look like it might be an interesting buy if analysts are correct, and certainly the company can reduce their operating expenses and try to get back into $1 billion less in SG&A. Particularly, they want to get down to that 1.7, $1.8 billion number at SG&A expenses versus that 2.7 billion they've had the last trailing 12 months. If they can do that, their operating margins are going to recover quite a bit. And hopefully they can also recover on the top line as well, too. PayPal, he sold in the quarter, sold some of Netflix as well. A lot of other positions, he kept the same, Occidental and some other ones. So interesting overall. I'd love to hear your guys' thoughts down in the comments below. I read all those. Again, if you're interested on know how to value companies or want to join my Discord, that's on Patreon. I'll put a link down below. Thank you so much for watching. Catch you on the other side. Take care and God bless.